Canaccord Genuity Group delivered a definitive top and bottom line beat against Wall Street consensus for Q1 fiscal 2027.
A massive beat, yeah.
I mean, adjusted revenue came in at 577.4 million Canadian dollars, which is up 28.8% year over year, and that beats the 539.7 million consensus by about 7%.
Right. And just to clarify, the strictly IFRS revenue was 573.6 million.
Exactly. And the adjusted diluted earnings per share hit 36 cents. That is an astonishing 176.9% year over year increase.
Wow.
Yeah, completely crushing the consensus estimate of 29.5 cents by 22%. And for guidance, management reaffirmed they are comfortably on track to deliver their full-year target of a low double-digit to single-digit improvement in firm-wide pre-tax operating margin.
Which is exactly what the market wanted to hear.
Right, but the stock reaction was fascinating. We saw an initial sort of modest pop of 0.41% to $14.76.
Nearing its 52-week high.
Right. Yeah, nearing the high, but then it pulled back into the close post-earnings at $14.37, which is down 2.64%. So looking at these numbers, you see a traditional financial firm practically tripling its bottom line in a single year, and you have to wonder, what is actually driving the mechanical engine underneath this EPS beat?
Well, what you're seeing here is it's the mathematical payoff of a deliberate, decade-long structural pivot. I mean, they haven't just had a lucky quarter where a few big advisory fees dropped all at once.
Right.
They've fundamentally rewritten the DNA of their business model by leaning heavily into wealth management. So if you want to understand why they beat estimates by 22%, you really have to look at how they transitioned away from relying solely on, episodic transaction-based revenue.
It's kind of like an anchor tenant in a shopping mall, right?
Yeah, that's a good way to look at it.
Yeah, you have your boutique specialty shops, which in this context is their capital markets division. And those boutiques, they have amazing months when a seasonal trend hits and terrible months when foot traffic completely dies down because, their business is highly cyclical.
Exactly.
But your anchor tenant, like the massive grocery store or the big department store, that brings in guaranteed recurring foot traffic every single day, rain or shine. For Canaccord, wealth management is that anchor tenant. It pays the rent, keeps the lights on, and it completely removes the existential pressure from the highly cyclical capital markets side of the house.
Yeah, and that structural shift is entirely visible when you just look at the revenue breakdown over time. I mean, wealth management now accounts for 53% of firm-wide revenue.
Over half.
Over half, yeah. And if you roll the clock back 10 years to fiscal 2016, it was sitting at just 31%.
That's a massive shift.
It is. They deliberately transformed from a transaction-dependent broker-dealer into a recurring revenue wealth manager. And, the market inherently assigns a higher valuation multiple to fee-based recurring revenue because it's predictable.
Right, you can bank on it.
Exactly. And you see the current impact of that shift in this quarter's segment data. The wealth management segment alone generated $305.1 million in revenue, which is up over 25% year over year.
And the pre-tax net income for that segment hit $57.1 million, which is nearly a 40% jump. But what really stands out to me there is the margin expansion. Margins expanded by 1.9 points to hit 19%.
Yeah, that's huge.
And this is driven by the sheer scale of the assets they're managing now, right? Total client assets hit a record $160.2 billion.
Which is a 27.9% year-over-year increase.
Right. When you have that much under management, the fees generated become this incredible steady engine. I mean, you're earning management fees, you're earning margin interest, you're sweeping cash. It just creates this durable floor for their quarterly earnings.
It does. But we also need to look at where that growth is geographically sourced, because the wealth market isn't monolithic.
Very true.
Canada saw a very healthy 32.9% increase in assets, which shows they're aggressively gaining market share in their domestic market. And the UK and Crown dependencies, they grew 14.1%. Reaching £43.4 billion in assets under administration.
But the real outlier here, I mean, the crazy number is Australia, right?
Oh, absolutely. Australian client assets surged 113.1%.
That triple-digit Australian surge, it needs some serious context for you listening because that was heavily aided by the integration of the Wilson's Advisory acquisition, which they completed back in October 2025.
Right, it wasn't just organic growth.
Exactly. It's a textbook example of inorganic growth buying a competitor to instantly double your footprint footprint in a key regional market. You absorb their client book, you eliminate overlapping back office redundancies, and you suddenly have massive scale in a market where you previously were just a mid-tier player. It immediately transforms the balance sheet.
It does, but, inorganic growth is effective for gaining sudden scale, sure, but it's also expensive. You pay a massive premium to acquire those assets, and you take on integration risk.
Merging tech stacks and cultures is never fun.
Rarely goes smoothly, yeah. Which is why CEO Dan Davio's commentary on the earnings call was so critical. He explicitly stated that giving advisors the tools to grow assets organically is, in his words, by far the highest return on capital.
Because if you simply provide your existing advisors with, say, better software, better research, or more intuitive client portals, they can attract new clients and capture a larger share of their existing clients' wallets with very little incremental cost to the firm.
Exactly.
Building a better tax loss harvesting algorithm or a smoother mobile app, that's a fixed cost. Once it's built, every new dollar an advisor brings in using that tool flows through at an incredibly high margin.
It's pure profit compared to the messy reality of buying up another firm and just hoping the acquired advisors don't jump ship.
Right, the retention risk is real.
Always. And that brings us perfectly to how this stable base interacts with the rest of the business. With the wealth management anchor tenant covering the baseline operating expenses, the capital markets division is freed up to act as a massive amplifier for this quarter's earnings.
Right.
When the baseline is covered, any surge in transactional activity drops straight through the income statement.
And it acted as a massive amplifier, I'll give you that, but I have to push back on this narrative of a flawless victory here.
Okay, let's hear it.
I am looking at an explosive 570.9% year-over-year jump in capital markets pre-tax net income. It went from $5.5 million in Q1 of last year to $37.1 million this quarter. You really have to ask yourself if a 570% jump is a sustainable run rate, or if they are just bouncing off a ridiculously depressed baseline from a terrible quarter last year.
I mean, a jump that large usually means the denominator was hovering near zero.
Exactly.
And you're right, it is absolutely a bounce off a depressed baseline. Deal-making and new equity issuance had virtually dried up a year ago due to macro uncertainty. So the percentage jump is distorted by that mathematical reality. The market was essentially closed for mid-market offerings.
Right. But the absolute dollars are still solid.
Yes, the absolute dollars generated still point to a very real resurgence in activity. Global capital markets revenue hit $260.5 million, up over 30%. Investment banking revenue alone was $87.2 million, which is up almost 40%.
And looking at the geographic breakdown of that investment banking revenue, it seems driven very specifically by strength in two resource-heavy markets. Canada brought in $32.8 million and Australia brought in $29.7 million.
Though U.S. investment banking also grew nicely, up over a third to $24.5 million.
True. Across all divisions, the firm participated in 91 global transactions, raising a total of $12.4 billion in proceeds. They are clearly capturing a significant slice of middle-market deal flow. Earning advisory and underwriting fees on $12 billion of proceeds, I mean, that moves the needle significantly.
They are capturing it, yeah. But we really need to issue a very clear warning based directly on management's own commentary here. A significant driver of this capital markets activity, particularly in Canada and Australia, was the mining sector.
Oh, and mining is notoriously cyclical.
Extremely. It goes through massive boom and bust phases based on underlying commodity prices, exploration budgets, macroeconomic sentiment, you name it.
Right.
Furthermore, management explicitly warned on the call that the pace of financing activity might moderate from these recent elevated levels depending on broader macro conditions. So the environment is constructive right now, but they're practically begging the market not to model this level of transaction velocity into perpetuity.
Yeah, temper those expectations. So let's connect this surge in revenue back to that headline EPS beat we talked about at the start, because the math underlying the profitability is really the most important part of this deep dive.
Absolutely.
Break this down for us. How exactly does a 28.8% increase in firm-wide revenue translate into a staggering 128.1% surge in pre-tax net income, hitting $76.1 million? The profit grew more than 4 times faster than the top line.
The answer lies in the degree of operating leverage, or DOL.
Okay.
This metric measures how a change in revenue affects your operating income, and it is entirely dictated by your ratio of fixed costs to variable costs. Over the last few years, Canaccord has spent massive amounts of capital building out a global wealth management platform.
Like the IT and compliance stuff?
Exactly. They've established rigorous compliance departments, back-office IT architecture, massive office leases in major financial centers, and core management teams. Those are highly expensive fixed costs. They have to pay for that infrastructure, whether they manage $100 billion or $160 billion in assets, and whether they underwrite 10 deals or 90 deals.
It's like running a commercial bus line. You have
Yeah.
to pay for the driver, the routine maintenance, and the gas, whether there is one passenger on board or 50 passengers. The cost of running the route is largely fixed.
And what happened this quarter is they packed the bus.
Ah, I love that.
Revenue jumped by nearly 29%. Because their fixed back office and infrastructure cost did not rise proportionally to service that new revenue, the incremental cost of each new dollar was incredibly low. The infrastructure was already built and paid for.
So every marginal dollar of revenue increasingly bypassed the expense line and fell straight to the bottom line.
That is exactly why we saw their firm-wide pre-tax operating margin expand by a full 5.7 percentage points, hitting 13.2%. When you combine a high fixed cost platform that has finally reached scale with a sudden surge in revenue like they got from the capital markets division this quarter, the operating leverage just supercharges the earnings per share.
Right, because the denominator of fixed costs basically remains static while the top line balloons.
Exactly. Margins expand rapidly.
But all this operating leverage, it comes at a price, specifically human capital. We've established the bull case, but we need to pivot to the red flags that could threaten these newly expanded margins going forward.
There's always a catch.
Always. I want to point out the compensation ratio. It is highly elevated. It sits at 59.5% on an adjusted basis. And if you include fair value charges, which is essentially the accounting adjustments for the changing value of the assets they hold on their balance sheet, it sits at 62%.
That's a big chunk.
Right. That means 62 cents of every dollar they bring in is going straight into the pockets of their employees. Are wage inflation and the sheer cost of retaining top producing talent just going to eat into all this newly found margin expansion over the next few quarters?
Well, it is the perennial challenge in financial services. Your most valuable assets go down the elevator and out the door every single evening.
Yeah.
If your wealth advisors and investment bankers are generating massive revenues, you have to pay them appropriately, or competitors just going to poach them. A 62% compensation ratio is an undeniable headwind to long-term profitability.
So what's management's take on this?
Management tried to contextualize some of the broader numbers to show they aren't losing control of the expense structure. They flagged a very large advisory fee they earned in Australia as a one-off event.
Okay.
Management explicitly warned analysts not to model that specific fee into future run rates, which also means the massive compensation tied directly to that one-off fee won't repeat either. It essentially artificially inflated the ratio for this specific quarter.
Ah, okay. That makes sense. But beyond the compensation ratio, there is some real geographic weakness acting as a drag on the broader firm. The UK capital markets environment is remaining structurally difficult and is hovering near break-even.
The UK has been a brutally tough market for mid-market equities for several years now. You have institutional pension funds structurally shifting their allocations away from domestic UK equities.
Then the liquidity issues, right?
Yeah, severe liquidity challenges on the AIM market, which is their alternative investment market for smaller growth companies,
Yeah.
and just a general drought of new IPO issuance. The UK team is essentially fighting for scraps in a shrinking pool.
Which drags down the whole segment.
It is a severe drag on the overall capital markets division, yeah. It forces the Canadian and Australian teams to carry the weight of the firm's global investment banking output.
And then you look at future growth prospects to offset that UK weakness. We talked about the Wilson's advisory acquisition in Australia driving that massive 113% asset growth. But management noted some severe M&A constraints going forward.
Right.
So if you are holding this stock, hoping Canaccord is just going to continually buy its way to the next level of growth, you really need to temper those expectations. Management clearly stated that it is valuation expectations, not a lack of capital on their end, that is currently constraining further acquisitions.
Private market valuations for wealth management firms haven't fully adjusted to the current interest rate environment. Target companies still want the massive multiples they could have gotten during the zero interest rate peak of 2021.
And Canaccord is just saying no.
Yeah, Canaccord is refusing to overpay. That is the disciplined move for shareholder value, of course, but it means they are heavily reliant on that organic growth engine we discussed earlier.
Right.
They have to grow by giving their current advisors better tools rather than just acquiring new books of business, because the bid-ask spread on acquisitions is currently just too wide to close.
So looking at the totality of this report, the massive beat, the phenomenal operating leverage, but also the high comp ratio and the structural UK struggles, how did Wall Street react? Covering institutions largely maintained their current ratings despite a massive EPS crush.
Yep.
They kept their strong buy ratings and maintained an average price target of $16.56, which, to be fair, still implies a very healthy 15.24% upside from the post-earnings close. Plus, the company declared a 10-cent Canadian quarterly dividend, yielding 2.78%.
Right.
But why are there no upgrades? If a company beats earnings estimates by 22%, shouldn't the price targets automatically go up?
It seems counterintuitive, I know, but you have to understand how institutional analysts build their discounted cash flow models. This earnings beat largely just confirmed the margin expansion they had already built into their long-term forecasts.
Ah, so it's already baked in.
Exactly.
Yeah.
They were fully expecting the operating leverage to kick in eventually as the wealth management platform scaled up. Canaccord just delivered it a bit earlier and more aggressively this quarter. So the quarterly models were validated, but a single quarter of accelerated margin expansion doesn't fundamentally change the 10-year terminal value of the firm.
Got it.
The analysts were already pricing in this success. The company simply proved the model's correct.
We started this deep dive talking about Canaccord's wealth management division acting as the anchor tenant in a mall, providing that safe, reliable baseline that lets the rest of the business take cyclical risks. But I want to leave you with a final, unaddressed question to ponder.
Go for it.
Buried in the commentary, the company mentioned they are having ongoing discussions regarding strategic options for its UK wealth management business. If Canaccord ultimately decides to spin off or sell this UK asset, will the firm lose the critical geographic diversification that currently protects that anchor tenant?
That's a big question.
Or will selling it finally unlock trapped value that the public markets are currently ignoring?
That is the massive strategic crossroads they are approaching. I mean, shedding the UK business might artificially boost their margins in the short term, but it concentrates their risk heavily into Canada and Australia.
Right.
How they navigate that decision over the next few quarters could completely redefine their valuation for the next 5 years.
It is definitely something to keep a very close eye on as the story develops. Make sure you follow the show for daily earnings coverage so you never miss the underlying mechanics driving the market.